When war around Iran starts threatening the Strait of Hormuz, one of the world's most sensitive energy choke points, fuel, shipping prices, and public anxiety begin moving in the exact same direction. And every time that kind of geopolitical pressure hits the system, millions of ordinary investors fall into the exact same psychological trap. They confuse reaction with control. You are likely sitting at home right now, watching inflation quietly devour your purchasing power, feeling the urge to protect whatever you have left. The headlines get louder, the financial forecasts get darker. The pressure to do something starts feeling responsible. Sell something, rotate something, protect something, change your portfolio before the next shock arrives. That instinct feels intelligent in real time. Most of the time, it is just expensive fear wearing the costume of discipline. We live in a digital age where speed is aggressively marketed as an advantage.
We are conditioned to believe that because we can liquidate our entire life savings with a single fingerprint on a smartphone screen, we are somehow safer. We assume that constant access to real-time data makes us smarter. In practice, it usually just makes us much more efficient at destroying our own wealth. We react to every breaking news alert, desperately trying to outsmart a financial system that is mathematically designed to strip us of our capital through friction, fees, and panic. Grace Groner built a fortune of more than $7 million by doing the exact thing modern investors struggle to do whenever the world becomes unstable. She did absolutely nothing. She did not look rich, she did not sound sophisticated. She lived in a tiny one-bedroom wooden cottage. She bought her clothes at local charity sales. She had no access to live market tickers, no financial advisors, and no economic models.
But she followed one brutal, undeniable rule that still humiliates most active investors and highly paid fund managers today. Once you own the right compounding machine, touching it too often is the exact mistake that ruins it. So the real questions are not just how an orphan secretary turned a single investment of $180 into a $7 million fortress. The real questions are these. How did a woman with an ordinary administrative salary behave with more emotional discipline than Wall Street professionals? What was the invisible compounding engine that kept one small purchase growing exponentially for over 7 decades without a single new dollar injected? And why does this specific story become more urgent and more useful whenever the world starts rewarding reaction over patience? This is not financial advice.
This is a documented historical and financial autopsy. And once you see the exact mechanism she used, the real lesson will not be about Grace alone. It will be a terrifying realization about how easily people destroy a perfectly good compounding engine with fear, impatience, macroeconomic noise, and the deep human need to feel active during unstable times. Her timeline of extreme wealth accumulation does not begin in a corporate boardroom. It begins in a damaged economy, with a modest job, a small paycheck, and almost no room for error. In 1931, the American macroeconomic landscape was operating under severe contraction. The Great Depression was destroying industries, jobs were fragile, and caution could turn into terror almost overnight. Grace entered that environment from the bottom. She secured a repetitive administrative position at Abbott Laboratories in North Chicago.
Her daily routine consisted of methodical filing and correspondence management. Nothing about her life advertised future wealth. But her analog socioeconomic isolation accidentally created the ultimate behavioral barrier. In an era where owning stock meant holding physical paper certificates, selling was not a frictionless process. It took time, effort, and bureaucracy. That analog delay established the exact psychological friction necessary to paralyze the impulse to sell during a crisis. She locked the capital away from her own interference, safely out of reach from human panic. Every time my broker charges me an inactivity fee, I think of Grace Groner holding physical certificates for 75 years without paying a single dime to Wall Street middlemen. This isolation proved mathematically superior. She starved the intermediaries. The broader market context makes the acquisition of those initial units deeply counterintuitive. The original purchase of the shares coincided with the tightening of financial regulations in the United States following the 1929 crash, a period when the common retail investor exhibited maximum revulsion to variable income assets. Advanced risk parity models mechanically allocate heavier capital concentrations into asset classes demonstrating peak negative sentiment. Her decision to purchase during the absolute depression trough mirrored the exact contrarian signal output of a 2026 institutional sentiment tracking algorithm. She bought the absolute fear. Watching the retail consensus flee from equity markets while a secretary accumulates shares exposes a permanent behavioral flaw. Public sentiment designated the stock market as a mechanism for systemic capital destruction. Groner ignored this collective panic and parked her scarce liquidity into corporate equity. The divergence between her absolute stillness and modern trading psychology is staggering. While we panic sell during 5% corrections, she let her dividends buy fractional shares automatically through the Great Depression. The contrast is humiliating. She established her position at the moment of maximum pessimism. The financial data proves that continuous heavy cash injections are not mandatory for systemic wealth creation. The initial seed capital remained the only significant block of equity she ever purchased directly. An administrative salary in the 1930s and 1950s never reached the threshold of high income, proving that a heavy initial capital injection is secondary to raw time in the exponential growth model. Her entire financial architecture depended entirely on the survival of those original 3 units of ownership.
The mathematical outcome of this solitary decision exposes the futility of aggressive modern trading. Time replaced heavy capital. $180 investment turned into enough to fund college programs perpetually. Time is the only leverage that actually works without carrying systemic liquidation risk. Howard Marks rigorously separates the concept of permanent capital loss from temporary price volatility. By utilizing only unleveraged cash, she completely eliminated the risk of margin calls, surviving what Marks identifies as the ultimate failure of debt-fueled speculation. She allowed the underlying business to generate value. No margin calls were possible. To guarantee the survival of this unmonitored portfolio, Groner engineered a domestic lifestyle defined by extreme friction against consumption. The habit of purchasing garments at local charity sales was not an imposed budget restriction, but a brutal allocation of free cash flow where saved currency never needed to be withdrawn from the portfolio. Warren Buffett insists on the absolute necessity of structuring permanent capital that cannot be recalled during macroeconomic panics. Her hermetic household budget engineered this exact, institutional-grade permanent capital structure, completely sealing the portfolio from domestic cash flow deficits. She built a financial fortress. By keeping her structural liabilities near zero, she mathematically eliminated the risk of personal ruin. Watching an individual achieve financial supremacy through deprivation forces a painful reevaluation of our modern habits. I spend 14 hours a day plotting moving averages and reading earnings reports just to lose 10% to inflation, and a secretary buys 3 shares and forgets them to become a whale. I am genuinely sick. This absolute synchronization between corporate equity ownership and Spartan living conditions forged an unbreakable holding strategy. She insulated her daily life. The asset was planted in the darkest economic winter of the 20th century and left to operate within the closed circuit of the pharmaceutical sector. The internal rate of return of the $180 operation transformed into $7 million, considering the 75-year window, mathematically annihilates the performance of 99% of modern hedge funds utilizing active management. She bypassed academic financial theory entirely. The real test of endurance would require decades of absolute immobility and total isolation from the financial media ecosystem. Charlie Munger heavily criticized the psychological contamination generated by constant market noise and analyst predictions. Her geographic and structural isolation served as the ultimate empirical execution of Munger's demand for independent, uninfluenced, rational holding. Silence was her primary edge.
The architecture of extreme wealth accumulation demands total detachment from the velocity of modern society. Grace Groner operated within a geographical and psychological vacuum, residing in a modest one-bedroom structure located on the periphery of an affluent Illinois jurisdiction. This decision to not modernize her small wooden house actively prevented the inflation of county property assessments. Institutional asset liability management desks utilize interest rate swaps to surgically cap future expenses. Her deliberate stagnation of real estate value functioned as a perfect biological swap, mathematically capping her tax liabilities and preserving maximum liquidity. She contained the cash. This physical containment neutralized the primary destroyer of retail capital across all market cycles. The internal pressure to display accumulated capital routinely forces market participants to liquidate high-performing assets to fund depreciating liabilities.
The fact that she did not upgrade her tiny cottage when the portfolio hit its first million proves that lifestyle creep is the ultimate enemy of compound interest. She barricaded herself against the consumerist escalation that surrounds the demographic of Lake Forest. The preservation of the principal required an environment devoid of physical upgrades. She defended the core. The operational paralysis she exhibited was not accidental, but a highly effective quarantine against macroeconomic noise. Modern quantitative models deploy algorithmic low-pass filters to systematically reject high-frequency data noise that triggers false execution signals. Her analog isolation from financial broadcasting erected an impenetrable firewall against the toxic data packets that constantly derail retail strategy. The lack of cable television and the absolute absence of continuous financial news streams preserved her mental state from the systemic anxiety of intraday volatility. The silence was absolute. Howard Marks insists that superior outcomes require a complete separation from the manic consensus of the crowd. Her systemic blindness to the daily news cycle mechanically enforced this contrarian isolation, rendering the panic of the herd mathematically irrelevant to her position. She possessed zero access to the flashing tickers and the manufactured panic of financial media. In naval engineering, an anechoic chamber absorbs all external acoustic frequencies to guarantee absolute stealth. Her total detachment from the financial media apparatus engineered a psychological anechoic chamber, rendering the chaotic sonar pings of Wall Street entirely powerless against her capital. She heard absolutely nothing.
The modern retail participant operates under completely toxic psychological conditions, bombarded by push notifications and algorithmic panic. I check my brokerage app 40 times a day. If I had simply deleted the app in 2015, my systemic capital destruction would never have occurred. Groner achieved perfect information asymmetry by knowing absolutely nothing about daily market fluctuations. The constant awareness of paper losses drives the retail mind toward protective liquidation, which locks in the permanent destruction of wealth. Ignorance protected the portfolio. Beyond media isolation, her domestic structure eliminated the internal frictions that historically forced the liquidation of family estates. Institutional boards of directors deploy shareholder rights plans to aggressively block hostile takeovers and forced liquidations. The structural absence of immediate heirs functioned as an impenetrable biological poison, defending the asset base from the aggressive capital extraction typical of family estates. The portfolio remains sealed, insulated from the emotional extortion that typically fractures multi-generational wealth. The lack of direct descending family members entirely suppressed the internal pressure to decapitalize the account to finance real estate bailouts or expensive divorces for offspring. Capital remained fully locked. Watching an individual survive decades without familial asset extraction exposes our own behavioral flaws regarding liquidity. The human brain naturally views available cash reserves as a signal to acquire comfort or rescue family members from economic distress. I am structurally incapable of holding cash without deploying it into high-risk trades. She let the corporate treasury do the heavy lifting while she shopped for used sweaters.
Her capital remained locked inside the pharmaceutical sector, safely distanced from any domestic emergency that might require a sudden withdrawal. The funds stayed invested. This austere daily routine did not equate to a penitentiary existence, but rather a surgical hierarchy of financial priorities. Modern corporate treasuries relentlessly shift from heavy capital expenditure into flexible operational expenditure to maximize free cash flow yield. Her explicit refusal to purchase vehicles or luxury real estate executed a flawless analog expenditure elimination protocol, protecting the primary compounding engine. Groner traveled extensively across the globe, evidencing that her frugality was an active rejection of planned obsolescence and physical assets, heavily favoring lived experiences over depreciating liabilities. She optimized the cash. Warren Buffett emphasizes that a rising equity price does not require a corresponding rise in the shareholder's standard of living. Her acquisition of second-hand garments, while controlling millions, perfectly executes his thesis of maintaining a vast disconnect between internal net worth and external validation. The contrast between her global mobility and her thrift store wardrobe violently dismantled the standard metrics of social status. Buying clothes at rummage sales while holding an institutional-grade portfolio is a level of psychological discipline I simply do not possess. I see green and I buy a new car. She maximized personal liberty while minimizing capital friction. She rejected status symbols. Her geographical location in a humble residence provided an invisible shield against the peer pressure inherent in affluent communities.
Charlie Munger repeatedly identified envy as the single most toxic and financially destructive psychological flaw in human behavior. By barricading herself against the escalating living standards of her affluent neighbors, she successfully neutralized the exact emotional trigger Munger warned against. The geographical isolation of Groner in her small residence limited her exposure to the envy triggers that force the common consumer to liquidate investments simply to match the visible lifestyle inflation of their neighbors. Nobody suspected that the elderly woman walking to church controlled a financial machine of institutional proportions. Envy destroys long-term wealth. Monish Pabrai asserts that the ultimate advantage in equity markets belongs to the operator who minimizes cognitive friction and embraces deep boredom. Her profound apathy toward her own portfolio empirically proves his argument that excitement and entertainment are fundamentally incompatible with compounding. The sheer apathy she demonstrated toward her own net worth remains statistically abnormal. The greatest financial defense mechanism is absolute boredom. If you make investing exciting, you are statistically guaranteed to underperform a dead account. The portfolio rotted in a drawer while she walked to the local pharmacy. Boredom yields massive returns. For over 7 decades, she executed a masterclass in operational paralysis. Charlie Munger famously codified his central strategy as the absolute necessity to sit on your hands and do nothing for decades. Her 70-year trajectory of uninterrupted holding serves as the ultimate empirical validation of his demand for extreme behavioral paralysis. There were no rebalancing strategies, no tax loss harvesting maneuvers, and no attempts to rotate out of the pharmaceutical sector into emerging technologies. The machine was powered exclusively by time and corporate earnings, completely devoid of human intervention. Paralysis builds extreme capital.
Howard Marks rigorously argues that the greatest risk to a portfolio is not downward price volatility, but the human intervention that locks in temporary losses. Her absolute refusal to trade eliminated the investor from the equation, destroying the exact risk Marks identifies. The original physical certificates simply sat in the dark, multiplying through corporate actions while the global economy burned and rebuilt itself multiple times over. Her absolute refusal to participate in the mechanics of trading protected the capital from the only variable that could destroy it. She mastered the agonizing art of doing absolutely nothing. Inaction proved mathematically flawless. The architecture of this wealth accumulation relied entirely on the internal mechanics of the selected corporation. Abbott Laboratories survived dozens of cyclical economic contractions because the baseline demand for diagnostic inputs and renal therapies operates with extremely low correlation to the national unemployment rate. Institutional portfolio construction utilizes beta-neutral factors to isolate returns from macroeconomic cycles. Her selection of a non-cyclical pharmaceutical enterprise empirically executed this exact defensive low-beta allocation, rendering consumer spending recessions mathematically irrelevant to the corporate cash flow. She ignored the macro cycles. This baseline demand established the foundation for permanent corporate survival across multiple economic eras. Warren Buffett insists that the core of any permanent investment is the identification of an impenetrable economic moat. The biological necessity of renal therapies and diagnostic inputs perfectly embodies Buffett's demand for a monopoly-like advantage that survives cyclical economic destruction. While the broader markets suffered through severe industrial recessions, the pharmaceutical sector provided a constant revenue stream immune to discretionary spending drops. The corporation generated cash continuously. The modern retail market completely misunderstands this fundamental reality regarding corporate durability. The speculative mindset constantly demands technological revolution while ignoring the compound power of established infrastructure. We are obsessed with finding the next disruptive tech unicorn, and she wrote a boring pharmaceutical dividend aristocrat to a massive 8-figure fortune. Stability systematically defeated aggressive disruption over the long term. Predictability generates massive wealth. The true engine of geometric capital expansion activated through a closed operational loop known as a dividend reinvestment plan. In thermodynamics, an exothermic reaction releases energy that becomes the catalyst for an exponentially larger secondary combustion. The automated dividend reinvestment structure operated exactly like this thermal feedback loop, systematically converting the yielded cash back into the underlying equity to accelerate the compounding velocity. The asset fueled its own exponential expansion. This internal mechanism operated as an absolute friction shredder for the retail investor. Groner paid zero brokerage fees to acquire the new fractional shares generated by the constant corporate yields. Modern corporate compliance architectures establish automated sweeping mechanisms to immediately redeploy idle cash into high-yield vehicles, eliminating cash drag. By forcing the transfer agent to automatically purchase fractional shares, she established an airtight cash sweep protocol that prevented any capital from remaining uninvested in her personal checking account. Efficiency was absolute. The realization of this passive superiority is brutal for active market participants who bleed capital through constant trading. This is the ultimate humiliation for day traders. We are fighting for pennies in the spread, while the drip machine quietly mints millions over decades of pure silence. Charlie Munger famously calculates that the combined frictional costs of active management and taxes will inevitably consume the vast majority of gross returns. Her zero-fee, tax-deferred compounding loop empirically validates his thesis that eliminating friction is more critical than selecting the perfect asset. Friction destroys market yields. This continuous reinvestment process effectively weaponized the corporate cash flow against fiat currency devaluation. Because the pharmaceutical dividends historically matched and eventually exceeded the inflation rate of the American currency, Groner held an underlying asset that mathematically preserved intrinsic purchasing power. Monish Pabrai structures his entire theoretical framework around the search for asymmetric bets, where a small, localized risk yields infinite upside. The mechanical transformation of 3 static certificates into a massive compounding engine embodies his absolute ideal of zero-effort, infinite return asymmetry. The mechanism protected her purchasing power. High-frequency trading firms spend billions to co-locate servers mere meters from exchanges to eliminate microscopic latency friction. Her absolute bypass of the brokerage industry eliminated the infinitely more destructive friction of management fees and transaction spreads, achieving a level of structural efficiency that algorithms cannot replicate. The corporation achieved the definitive archetype of a dividend aristocrat, paying and increasing consecutive cash distributions for decades without interruption. This mechanical reliability transformed a static paper certificate into an aggressive compounding vehicle. Capital expanded in silence. The contrast with modern financial products exposes a massive systemic flaw in how retail investors approach wealth generation. She bypassed the entire wealth management industry. No advisory fees, no loads, no spread costs, just raw, unadulterated corporate earnings compounding over biological time. The system fueled its own growth without demanding a single percentage point from the operator. Zero capital leaked out. Beyond the dividend distributions, the capital multiplier accelerated through massive structural growth within the underlying business itself. Abbott executed strategic acquisitions and international expansions throughout the 1980s and 1990s, permanently increasing the earnings per share that directly fed the fractional shareholder base of Groner. The company scaled the production of critical antibiotics and clinical nutrition brands, dominating global market share across multiple continents. She owned a permanent fraction of this global infrastructure. The business scaled globally. The modern speculator fundamentally fails to grasp the mechanical reality of equity ownership, viewing stocks merely as vehicles for short-term price arbitrage. Warren Buffett repeatedly admonishes the retail market for treating stocks as speculative casino chips rather than fractional ownership of a business. Her 70-year perspective of owning physical medical manufacturing infrastructure perfectly executes Buffett's fundamental requirement for business owner psychology. We treat stock tickers as lines on a screen to be traded. She treated her 3 shares as ownership in a real business that manufactured physical medical supplies. She possessed an owner mentality. The final catalyst for this massive share accumulation involved the execution of institutional stock splits over several decades. A stock split does not alter the intrinsic value of the enterprise at the moment of execution, but it reduces the unit price of the equity, expanding the total volume of paper held by the long-term investor. The original 3 units divided in 2-for-1 and 3-for-1 ratios repeatedly over 7 decades. The visual expansion of the share count provided a powerful behavioral anchor for the investor. Stock splits are pure psychological engineering. Giving the retail investor more shares without changing the value keeps them holding. It worked perfectly on her. She never interrupted the process. Through the combination of automatic dividend reinvestment and repeated stock splits, the 3 original units from the Great Depression proliferated into an audited inventory of over 100,000 shares. Howard Marks argues that the highest form of risk management is the absolute refusal to interrupt a structurally sound process. Her ability to maintain her administrative employment while allowing the corporation to execute all logistical and capital allocation tasks proves his principle that superior returns require supreme inactivity. The corporation handled all the capital allocation, research development, and global logistics, while the secretary simply maintained her employment and refused to sell. The machine operated autonomously. The mathematical certainty of this closed-loop operation crushed any active trading strategy deployed by Wall Street professionals over the exact same timeline. Monish Pabrai champions the cloning of successful, highly resilient business models, requiring the investor to simply allocate and disappear. She achieved the ultimate expression of this philosophy by purchasing a cash-producing pharmaceutical monopoly and completely removing herself from the operational equation for 7 decades. The machine required absolutely zero intelligence from the operator once the initial switch was flipped. She simply bought a cash-producing asset and got out of the way. The mathematics operated flawlessly. The ultimate test of this passive architecture required surviving decades of severe macroeconomic trauma without a single structural modification.
That was the hard part. Not buying, not understanding the thesis. The hard part was surviving history. Grace held through war, inflation, crashes, speculative manias, and recessions severe enough to make intelligent people sound completely certain that patience was no longer rational. Every market cycle arrives dressed as a unique emergency. That is one of the oldest traps in finance. Fear always insists that this time the rules have changed permanently. People panic, they liquidate, they protect themselves from volatility by locking in permanent damage. Then the exact thing they sold recovers without them. Grace did not defeat every crisis with a new tactical defense. She outlasted them by refusing to convert temporary stress into permanent action. Modern investors still tell themselves the same lie during every major shock. They think reacting quickly is the same thing as managing risk.
Often, it is just a cleaner way to crystallize losses. Grace's behavior makes a harsher point. In many cases, the greatest risk is not the crisis itself. It is the owner who cannot stop touching the position while the crisis is unfolding. Crisis after crisis, the same behavior that looked unsophisticated in calm periods turned out to be brutally effective when the system became unstable. She did not need to predict which crisis would matter most. The position did not survive because she mastered timing. It survived because she removed herself from the reflex to time the market. Investors do not usually blow themselves up because they fail to understand economics in theory. They do it because they cannot endure uncertainty without turning it into action. They need to move. They need to protect. They need to prove they are not passive while events outside are becoming frightening. Grace did the harder thing.
She let a durable business absorb the shock while she refused to sabotage the ownership from the outside. You do not need another Great Depression or another housing collapse to understand the pattern. When fear becomes social, people start treating movement as wisdom. They would rather be busy than right. They would rather make a visible mistake than sit through an invisible test of patience. Grace could remain still without mistaking stillness for weakness. Every shock offered a new excuse to believe that discipline should be abandoned. She kept refusing the invitation.
In the year 2010, Grace Groner passed away as a centenarian, triggering the final opening of her estate and initiating a profound institutional shock across the financial sector. When the legal inventory was finally revealed, the accounting spreadsheets needed to process 7.5 decades of compound interest mathematics, establishing an absolute nightmare for cost basis tracking and tax control. High net worth family offices implement advanced software to harvest tax losses and track cost basis. The 7 decades of unmonitored dividend reinvestment operations established an analog tax deferral architecture so dense it required forensic accounting to unravel. The sheer volume of the account at Abbott Laboratories exceeded $7 million in market value, entirely generated from the original $180. The math terrified the professionals. This monumental accumulation required an environment of total secrecy to prevent external value extraction. Her restricted fiduciary relationship with her local attorney and college board members maintained the strict anonymity of her net worth, preventing external extortion or excessive appeals from third parties during her life. The revelation of this hidden capital completely dismantles modern fiduciary assumptions regarding the necessity of active management. Charlie Munger states that the wealth management industry exists to enrich the managers, not the clients. Her ability to build a massive estate without a single advisory fee serves as the ultimate empirical proof of his cynical thesis. I pay a wealth manager 1.5% assets under management annually to underperform the index, and a secretary managed a multi-million-dollar estate using absolute zero effort. Silence protected the capital. The resolution of the first mystery vector explains how ignorance forged an unbreakable financial defense. We must ask how her refusal to track daily market prices executed Warren Buffett's exact requirement for a permanent capital structure. By maintaining zero awareness of the current valuation of her Abbott shares, she physically removed her own ability to execute a panic sale during a downturn or a greed-driven liquidation during a peak. Warren Buffett emphasizes that deferred taxes operate as an interest-free loan from the government. Her 75-year holding period maximized this exact invisible advantage, applying the unpaid capital gains taxes to aggressively compound her final net worth. She locked the money away. The central financial thesis of this unprecedented case manifests precisely in its brilliant post-mortem tax efficiency. The transfer of the shares to the Lake Forest College Foundation avoided the application of the maximum capital gains tax rate, which would have vaporized 15 to 20% of the nominal capital upon liquidation. Institutional wealth managers employ donor-advised funds to surgically eliminate capital gains exposure. Her transfer of the appreciated equity directly to a foundation executed this exact contemporary tax avoidance protocol, completely bypassing the taxable liquidation event. Instead of bequeathing the amount to direct heirs and subjecting the estate to predatory succession taxes from the Internal Revenue Service, Groner established a 501c3 foundation. The state confiscated nothing. This specific legal mechanism allowed the massive accumulation of equity to bypass government confiscation entirely, transferring the asset intact to the educational institution. Watching a retail participant execute this level of structural defense is deeply sobering for market professionals. The tax efficiency of transferring the appreciated assets to a charitable foundation instead of selling and getting crushed by capital gains is institutional-level estate planning. The architecture of the Grace Groner Foundation operates as a classic academic endowment, specifically designed to perpetuate the existence of the principal capital while distributing only the excess yield. In hydrodynamic engineering, a spillway safely releases excess water pressure without compromising the dam.
The foundation structure functioned precisely as the spillway, constantly distributing the dividend yield while guaranteeing the structural integrity of the principal capital remained untouched. The core remained solid. Lake Forest College received the massive sum under the strict prerogative to generate yields for student welfare, actively shielding the donation from the operational expenses of the rectory. This mechanism ensured that the millions of dollars would perpetually fund international study programs and unpaid internships through the annual dividend distributions alone. The realization of her absolute detachment from the financial machinery provides a sharp contrast to our daily anxiety. I look at the Bloomberg terminal and see pure systemic risk. She looked at her mail once a quarter, filed the dividend statement, and went for a walk. The principal remained untouched. The second mystery vector demands an explanation of the underlying growth engine. What was the invisible mathematical feedback loop that allowed a single pharmaceutical company to continuously fund her equity expansion without external cash? The answer resides in the relentless efficiency of the dividend reinvestment plan operating inside a monopolistic medical enterprise. Every quarter, the corporation generated massive free cash flow from diagnostic tools and antibiotics, distributing a portion to Groner, which was instantly converted into microscopic fractions of new shares. Algorithmic high-frequency platforms rely on retail transaction volume to capture the bid-ask spread. Her total refusal to rotate assets starved this institutional friction engine, mathematically proving that extreme inactivity is the absolute defense against structural wealth extraction. She starved the machines. Modern risk parity portfolios continuously rebalance to maintain strict volatility targets, triggering continuous taxable events.
By rejecting this active reallocation mandate, she isolated the portfolio from the systemic tax drag that systematically drains long-term retail returns. This continuous compounding loop operated without requiring a single new dollar from her administrative salary, turning the corporate treasury into her personal wealth generator. The conclusion of this documentary delivers a ruthless mathematical verdict regarding capital allocation. The trajectory of this portfolio exposes the fallacy of fiduciary complexity, proving that the most powerful asset Grace Groner possessed was not analytical intelligence, but raw time and uninterrupted operational apathy. Time conquers intellect. Every transaction executed by a retail investor introduces friction, and that friction systematically degrades the exponential curve of the portfolio. Wall Street relies entirely on the illusion that constant action generates superior returns. The empirical evidence provided by this specific estate proves the exact opposite reality. Her story mathematically destroys the illusion of the active trading lifestyle. Action equals friction, friction equals fees, and fees destroy compounding. Charlie Munger mathematically proved that high trading friction guarantees the death of capital accumulation. The absolute absence of fees in her 7-decade timeline validates his assertion that avoiding stupid mistakes is vastly more profitable than seeking brilliant transactions. Activity destroys wealth accumulation. The final mystery vector addresses the behavioral fortitude required to execute this strategy. What psychological mechanism allowed her to achieve the extreme operational paralysis that Howard Marks identifies as the ultimate defense against capital destruction? The mechanism was absolute emotional detachment and the complete removal of ego from the financial process.
Monish Pabrai bases his philosophy on the premise that high intelligence becomes a disadvantage when it leads to overactivity. Her absolute operational apathy perfectly mirrors his demand for passive holding rather than hyper-intellectual trading maneuvers. She possessed no desire to prove her intelligence to the market, allowing her to simply own a productive asset and completely ignore its daily valuation. Ego ruins the portfolio. By sealing the asset inside a pharmaceutical corporation and ignoring macroeconomic data, the protagonist isolated the capital from human psychological interference. Howard Marks rigorously argues that an investor's worst enemy is their own emotional inability to withstand cyclical pain. Her stoic refusal to liquidate during historical crashes confirms his principle that psychological endurance dictates ultimate financial survival. The financial advisory sector operates on the mandate of constant portfolio rotation to justify management fees, a process that inherently triggers tax events and interrupts the compounding process. This structural reality makes the common retail investor a constant source of revenue for institutional intermediaries, draining the overall yield. Action bleeds the account. The true challenge does not reside in identifying the optimal asset, but in surviving the biological urge to liquidate it during periods of high volatility or sudden prosperity. Accepting this reality forces a painful admission about our own behavioral deficits regarding money management. The real lesson here is not just picking the right stock, it is the psychological fortification against your own destructive human instincts to meddle with a working system.
Charlie Munger repeatedly declared that the desire to get rich quick is the most dangerous financial delusion. Her lifelong dedication to a single asset encapsulates his final lesson. The ultimate compounding engine requires a timeline that outlasts human anxiety. Patience is highly profitable.